There's one thing Wall Street analysts obsess over. One thing that moves markets in a single day. One thing that makes central bankers the most powerful people on the planet. Interest rates. And while most investors react to rate changes with panic, buying, selling, switching strategies every few months, Warren Buffett, the man who turned $10,000 into over $100 billion, has a completely different way of thinking about them. He doesn't predict them. He doesn't fear them. But he respects them deeply. In this video, we're going to break down exactly what Warren Buffett thinks about interest rates, in his own words, from decades of shareholder letters, annual meetings, and interviews. By the end of this video, you'll understand something that most retail investors never grasp, and it might completely change how you look at your own portfolio. Let's get into it. In 2013, at Berkshire Hathaway's annual shareholder meeting in Omaha, Warren Buffett said something so simple, so profound, that finance professors still quote it in classrooms today. He said, "Interest rates are to asset prices, sort of like gravity is to the apple." Think about that for a second. Gravity is always there. You don't see it, you don't touch it, but everything in the physical world is affected by it. The moment gravity weakens, things float. The moment it strengthens, everything is pulled back down to earth. Interest rates work exactly the same way on financial assets, stocks, real estate, bonds, businesses. Every single asset you own is in a constant tug-of-war with the interest rate environment. Buffett even joked at Berkshire's 2021 annual meeting. "If I could reduce gravity's pull by about 80%, I'd be in the Tokyo Olympics jumping." It sounds funny, but the message is dead serious. Low rates effectively reduce that gravitational pull. Assets can rise higher. Businesses look more valuable. Stock prices climb. And when rates rise sharply, gravity returns and hard. This isn't theory. This is the single most important force shaping every investment decision. And Buffett has been saying it for decades. Now, let's understand the mechanics, because this is where Buffett's thinking gets really powerful. Every business is essentially a machine that produces money in the future. When you buy a stock, you're buying a claim on that future stream of earnings, whether it's 5 years from now, 10 years, or 30 years. But here's the critical question. How much is money in the future worth today? The answer depends entirely on interest rates. Investors use a technique called discounted cash flow, or DCF, to figure out the present value of future earnings. And the discount rate they use is based on prevailing interest rates. As Buffett put it in a 2012 interview, interest rates are to the prices of all assets like gravity is to the function of the earth. Everything is based off interest rates. It's a huge gravitational pull and affects what I'm doing. Here's the simple math. If interest rates are at 1%, a dollar you'll receive 10 years from now is worth about 91 cents today. But if rates are at 8%, that same future dollar is only worth about 46 cents today. That's why rising rates are devastating for high-growth companies, the ones whose earnings are expected far out in the future. When you raise the discount rate, you're cutting the present value of those distant earnings in half. And in 2017, Buffett summarized it beautifully. The most important item over time in valuation is obviously interest rates. If interest rates are destined to be at very low levels, it makes any stream of earnings from investments worth more money. This is Buffett's lens. And it explains so much about how he has invested over 6 decades. From 2009 to 2021, something extraordinary happened in financial history. The Federal Reserve held interest rates near zero, not for a month, not for a year, but for over a decade. At Berkshire's 2021 annual meeting, Buffett said that near zero rates had created an incredible change in the valuation of everything, because of the reduced incentive to hold relatively risk-free government debt. He described low rates as making stocks look like bargains. Think about what that means. When Treasury bonds yield nearly nothing, investors pour money into stocks, real estate, crypto, venture capital, anything that might generate a return. Asset prices everywhere inflated. Tech stocks with no profits were valued at hundreds of billions. SPACs were raising billions on pure speculation. Real estate prices in cities like Mumbai and New York went vertical. All of it floated on the cushion of near-zero gravity. But Buffett, ever the disciplined thinker, never forgot that gravity always returns. He kept building Berkshire's cash reserves even as others called him too conservative. He resisted overpaying for acquisitions. He stuck to his principle: never assume today's interest rate environment is permanent. And he was right. In 2022, the party ended. After keeping rates near zero for most of the previous 15 years, the Federal Reserve embarked on its most aggressive campaign to lift borrowing costs since the 1980s in order to fight stubbornly high inflation. The Fed funds rate rose to a range between 5.25% to 5.5%, the highest in over 2 decades. What happened? Gravity came back, hard. The Nasdaq fell nearly 35% in 2022. High-growth tech stocks that had floated on cheap money crashed. The bond market had one of its worst years in history. Real estate transactions froze. Everything Buffett had warned about for years played out in real time. As analysts noted heading into 2023, 6-month and 1-year Treasury yields had both surpassed 5% for the first time since 2007, while the benchmark 10-year Treasury yield had risen sharply. The surge in yields raised concerns that it would dent the appeal for equities and hurt asset prices, exactly what Buffett had long described. And what did Buffett do? Something most people didn't expect. He welcomed it. In his own words from 2024, "I don't mind at all, under current conditions, building the cash position. When I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it, the interest rate available on cash, quite attractive." Fidelity. By the end of 2025, Berkshire Hathaway's cash balance had grown to $373 billion, equating to 36% of the company's total market value. Fidelity. Buffett wasn't hiding. He was waiting, patiently, rationally, with the discipline that only comes from truly understanding how rates affect asset values. Here's the part that surprises most people. Despite knowing more about interest rates and their effect on valuations than almost anyone alive, Warren Buffett has consistently refused to predict where rates are going. Buffett himself has said that forecasting interest rates has never been his or Charlie Munger's game. Think about how different that is from the average investor. Most people spend enormous energy trying to figure out whether the Fed will cut rates once or twice, whether the 10-year yield will hit 5% or fall back to 3%. Whether to rotate into growth or value based on the next Fed meeting. Buffett ignores all of that. Why? Because he's been watching this game long enough to know that nobody, not economists, not Fed governors, not Nobel Prize winners, can consistently predict where rates will go. Instead, Buffett uses rates as a context, not a prediction. He asks, given where rates are today, what are assets fairly worth? If rates are high and stocks are still expensive, he waits. If rates are high but stocks are cheap relative to those rates, he buys. If rates drop suddenly, he reassesses. He doesn't bet on the rate environment changing. He invests in great businesses that can thrive in any rate environment, companies with pricing power, strong free cash flow, durable competitive moats, and the ability to raise prices when inflation forces their hand. This is the key insight most people miss. Buffett isn't an interest rate trader. He's a business owner who uses rate awareness as one filter in a much larger decision-making process. So what does all this mean for you as an individual investor? Let me give you 3 clear takeaways. Lesson 1: respect the environment, don't fight it. When rates are high, cash and short-term bonds are real competition for stocks. Don't force equity investments just because you're afraid of missing out. Buffett sat on $373 billion in cash for a reason. Lesson 2: be skeptical of high-priced growth stocks when rates rise. Remember the DCF principle: rising rates crush the present value of distant future earnings. The more a company's value depends on earnings 10 or 20 years from now, the more vulnerable it is when rates climb. Lesson 3: focus on businesses that can survive any rate cycle. Coca-Cola, Apple, BNSF Railway. Buffett's core holdings share one trait: they generate strong cash flows right now, have pricing power, and aren't dependent on cheap credit to survive. That's the fortress you want to own, at the right price. And above all, don't waste your energy trying to predict rates. Even the world's greatest investor doesn't. Warren Buffett has watched interest rates go from double digits in the 1980s, to near zero in the 2010s, to the highest levels in 2 decades just recently. Through every cycle, his philosophy has stayed the same. Know what rates mean for value. Build businesses and portfolios that can withstand gravity at any level. And have the patience to wait for the moment when price and value truly align. That's not just investing wisdom. That's financial common sense. If you found this video useful, please like and subscribe. We cover Warren Buffett, Charlie Munger, and value investing principles every week in a way that's simple, practical, and built for long-term thinking. I'll see you in the next one.